My father often told me, when it comes to trading and investing, follow the money and not your opinion. But what do you follow when price and reality simply don't match up? Well, in times like these, we get back to the fundamentals. So today, we're going to tackle the short, medium, and long-term perspectives. We'll look at credit spreads, as well as what caution signs are flashing red on the horizon. We're also going to look at GDP. We got the Q1 2024 GDP data, and things are not looking too good. A huge miss coupled with high inflation saw the market falter in early hours trade, and while almost all of those losses were parred in the after hours, we need to ask the question, are we seeing early signs of 70s style stagflation? But the real story on everyone's lips is big tech. We're going to look at the earnings of Google, as well as the biggest stock in the world. We'll also be diving into why the S&P 500 moved the way it did, seasonal data, and what to expect as April draws to a close. Could it get worse before it gets any better? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stock and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. This heat map is not indicative of what's going on after hours at the moment. Now there's a couple of key things I want to point out first. Semiconductors, super green, and that was because of Meta's earnings call. Even though Meta had great earnings, by the way, they were down 10%. What came out of their call really benefited semiconductors, and it pretty much signaled that Google, Apple, Microsoft, Amazon, pretty much every single tech company is gonna have to keep spending here in semiconductors because of AI for at least the next 2 to 3 years. And that means the AI trade, the semiconductor trade is well intact, and that's why semiconductors were up big today. Tesla was up another 5%. Very weird to see them up another 5%, and maybe an interim bottom has been put in around that 140 level there for Tesla. We saw industrials show quite a lot of strength. There were a couple of earnings reports in there that were really good, despite the actual dumpster fire of earnings Caterpillar put out. And we saw some weakness on the back of financials, but let's be real, they've absolutely run up the most. You know, American Express, I was looking at it just yesterday. It's part of the undervalued portfolio. American Express is up 66% in the last 6 months. Absolutely wild what's happening with that stock. But some concerning things we did see today, utilities, energy, they did put out fairly green days, and we're going to talk about why. And it all had to do with the GDP report. Now, GDP data came in, very concerning stuff right there. And you can actually see that GDX, XME, XLB, XLE, a bunch of these inflation hedges, commodity driven sectors really led the pack today. You could really see a ramp up here after that GDP report. GDP actually did come in a bit soft. Some politicians call it Bidenomics. The rest of the world, we call it stagflation. Semiconductors was the second best producing sector overall, and that really did boost the SPY. And then the worst performing sector here was comm services, and we know that just had to do with Meta. But we're going to talk about what happened after hours in this sector. Big moves happening, and we're going to see very upbeat action in this sector tomorrow. But all in all, guys, a very mixed day of trade. The market getting a bit jittery in some places, looking real upbeat in other places. But how about we hop on the charts and look at everything in detail? So guys, in aggregate, when you look at all of the indices, right, look at the S&P 500, NDX, RSP, midcap, S&P 600, IWM. It was a red day across the board. Open to close, it was a red day. You can't deny it. However, this is the SPY. Look at what we're doing after hours here, up 0.82%. And that's on the back of Microsoft earnings. That's on the back of Google earnings. Can't actually see it, but you know, Google traded at the close 157. They've rallied all the way up here to 178. And that's a 10 to 12% move in the after hours. However, it's not a broad-based move in the market because the RSP is down after hours 0.25%. The SPYG is actually up 1.97%. The S&P 500 value is down 0.5%. So the move after hours is definitely attributed to these bigger names. The nasdaq is going to be the biggest beneficiary of that, but it isn't a broad-based move, and that's a little bit concerning because we did see the market come under pressure after that GDP print very early on in the session. Now, looking at overall yields did spike initially, and how do we know this even though these are after hours sessions? Is because bonds were down on the day, but we particularly saw this in TLT AGG, right? So investment grade and government bonds. On the back of all of that, so we saw upbeat action in gold, we saw upbeat action here in silver, these commodity hedges. We actually saw the dollar come down, And then we saw crude oil move up ever so slightly. And then Bitcoin is also up 1%. But let's actually have a look at the S&P 500 because the action was actually pretty ugly intraday. Now let's hop on the 5-minute chart and just have a look at everything. Now we had a big gap down all the way here, and then we made higher highs, lower highs, all the way to pretty much the high of the day. We actually didn't put in a lower low once we made this low right here. Very interesting when you consider that. And I do think that we're probably going to gap up tomorrow on the strength of some of these mega caps here in the S&P 500. But going back to the daily chart, we're still playing in this range. Now, if we actually just go to the SPY, you can actually see in after hours trade right here, we're actually above yesterday's high. Going back to the SPX, this is where we did close just below this 50-70 range. So we are back into this range. And I said yesterday, as long as we're inside this range, this 50-70 to 51-50, you want to buy dips, sell rips, and look for 5100, look for 5149. Below this area, you want to really find support this low right here, this level, 50.25, and then the 5,000 level. That's exactly what we found. So, if you did buy the dip at this point, move higher, I'm sure you're up big, especially now that after hours, we're back in this zone. We're back in positive gamma, especially if we open in that zone tomorrow. You do want to then buy dips, sell rips, and look for these higher price actions. Now guys, earnings is coming in very, very good. The fundamental picture from an earnings basis has not changed. The macro picture is deteriorating, but a lot's going to depend on the PCE print tomorrow. Based on the GDP number we got today, if PCE comes in hot tomorrow, there is going to be a huge sell-off. It might not be reflected in the market indices because we're going to have a big update in Google, in Microsoft, in tech, but you want to look at the RSP. That's what you want to look at. PCE comes in cool tomorrow or in line, pretty much in line or cool, then that should support the market for the most part. But guys, listen, above here, you want to buy dips, sell rips, look to 5100. Below this 50-70 zone, you really just want to sit out the volatility and enter positions at the key support zones here at 50.25, 5,000, and potentially as low as 49.80, 49.75. Let's talk about the earnings scorecard. We've had a big uptick since yesterday. So this was yesterday's results. This is after today, and you could see the massive changes right here. The S&P 500 earnings growth has actually ticked up to 3.3% from 2.9. That's a big change. Up 6% here excluding energy, and then excluding the BYM adjustment, 6.4%. So major changes here, and this should continue to ramp up, especially after next week when we get some of the other bigger players. And earnings is looking really good. The sectors that are supposed to be producing earnings are, sure, what stocks are doing might be different. Look at Meta, look at Tesla. Regardless of what the actual price of the stock is doing, earnings is coming in really good. And what good earnings means for us as investors is that stocks are becoming cheaper on an earnings level basis, and even more so if they pull back. Now let's actually talk about the earnings we had today. We're going to look at the big dogs, Microsoft and Google or Alphabet. Microsoft, a double beat here, EPS of 294 versus 282. That's a beat on sales of 61.9 billion. That's a double beat there by Microsoft. Cloud revenue increased 21%. I believe the street was expecting something like 19% or 20%. It beat on cloud revenue. That's why the stock was actually up after hours, and personal compute revenue was up 17%. So a great showing here from Microsoft. The whole tech sector as a whole is going to rally on the back of these earnings. At the same time, Alphabet earning, Google, whatever you want to call it, EPS 189. The street was expecting 151. And the reason why we got this number right here is because the company actually found a lot of operating leverage in this quarter. EPS was done on sales of $80 billion, and 78 billion was what the street was expecting. A little bit more, 78.59. And yeah, Google found a lot of operating leverage this quarter. That was reflected in their EPS. They authorized $70 billion worth of buybacks. But the reason why the stock was up 12% in after hours was on a newly initiated 20 cents cash dividend. I think it's something like a 0.50% dividend for the year. This is fantastic news for shareholders, and a whole bunch of dividend growth investors are suddenly now Google shareholders. Trust me, you're going to see all the posts on Twitter. But great earnings. This is going to help tech. This is going to help communication services. This This is going to help a whole bunch of stocks in the tech sector. Great earnings is going to really help the overall market sentiment, and I think we're going to see a pretty big rally, and I think we're going to probably keep seeing strength in Google for the rest of this quarter. You know, the last 3 quarters, Google has actually dropped 10%. They run up to earnings, dropped about 10%, and then rallied all the way up. This is the first time in quite a number of quarters where Google's like rallied up into earnings, right? And then like further rallied after the earnings. So, you know, definitely a sentiment shift here from Google, and we probably are going to see some form of multiple expansion. That's what you get when you release these type of earnings, find operating leverage, authorize $70 billion worth of buybacks. You're definitely going to see this multiple expand, probably upward earnings revisions, especially with these EPS figures right here. Now guys, I showed you this chart yesterday, and it's just the small cap S&P 600 and S&P 500 projected earnings growth through to 2025. You can see that while small caps are expected to report a negative growth rate this quarter, that does accelerate in a major way for the next 3 quarters, and then we do see decelerated earnings growth in 2025 from the peak year in the 4th quarter of 2024. However, do understand that this is still above 20% and roughly at about 15% growth for the rest of 2025. And you guys already know this, it was in yesterday's video. The reason why I showed you guys this again is because I wanted to relate it to valuation. Now, I don't have the absolute perfect analog, but I do have a like-for-like scenario. This right here is the Russell 2000, and it's very similar to the S&P 600, slightly different. The Russell 2000 has a little bit more micro caps than small caps. That being said, the major components of both indices are roughly the same. And you can see here that the Russell 2000 is no longer cheap. It's actually trading at its average valuation since 1985. Does that mean it's a bad investment? Not necessarily. Here in October, November 2023 was definitely a better time to get into small caps. That's exactly when I told you guys to get into small caps. But the current valuation of the RTY at 15.75 forward PE implies a 9% annualized return for the next 10 years. And that's actually a really good return. I know sometimes in the equity markets we can get caught up with the Nvidias and the super micros of the world. But sometimes putting your money into something that'll compound it at 9% annually for the next 10 years is not a bad investment at all. It's just a set and forget thing, and you just collect those dividends, reinvest those dividends, and just hold. Now let's talk about the health of the economy, because we got a couple of data points and this is getting concerning. We got the latest GDP data, came in at 1.6% right here. The forecast was actually 2.5%, the consensus, and this is a little bit concerning. I know that for a quarter that growth is all right, but you got to think about where inflation is and what the economic growth is. So lower economic growth, higher inflation, and this was part of the reason why markets actually gapped down on the open today. Part of it actually had to do with Meta and tech earnings, yes, but a lot of it was this GDP print. At the same time, the initial jobless claims figure did kind of ease the GDP, the weak GDP print. I mean, initial jobless claims came in at 207. We were expecting 214. This tells us that the labor market remains secularly tight. It is a slight beat, and in a stagflationary environment, you kind of need a real weakening labor market, and we're not seeing that. However, what this data does tell us, not so much the jobless claims, but the GDP print, is that the government is terrible at turning their spending into actual GDP. They've spent so much for 1.6% GDP. I mean, with that spending, I think with this figure, it probably means the government is spending $5 or $6 to get $1 back in GDP. That is not constructive. That is not sustainable. So we are going to keep a close eye on the economic data this quarter. I know we do, but particularly we're going to look at GDP, GDP now, GDI, and all of those figures, because a big part of the rally we saw in the S&P 500 actually had to do with the fact that the economy was strong, and that GDP figure puts cold water on that fact. Also, guys, don't be surprised if the government comes out and just revises this GDP figure to 2% plus. Janet Yellen came out and said there could be revisions to this GDP data. So if they do that, the market is going to take any reason to rally when it comes to that. But nonetheless, this data is very concerning. Now let's talk about Gamma, guys. I'm not going to go over it. We went over yesterday's video. I'm not going to go over it in depth, but the Gamma flip zone is here at 50.75. It moved up a hair. The put support actually moved up to 5,000, which is very, very interesting from the 4,900 level. level, and then this moved to 5100. So that is bullish in a sense. You can see these zones are compressing here. However, we are still in elevated levels of negative gamma, and below the gamma flip zone, we are going to get volatility. So really you want to sit out the volatility below this zone and buy dips, sell rips all the way to the 5100 level, maybe 5200 level here in the S&P 500. But do pay attention that below this 5075 level, things do get a bit scary for the bulls. Now looking at some seasonal data, guys, I have a very interesting analog right here. This is the 2012 analog, and it compares the S&P 500 and its path in 2012 versus the current path here in 2024. And you can see, while not perfect, we've generally followed the exact same path, even down to the dates. You could see that we've roughly pulled back at around the same time here in 2024 like we did in 2012. This 2012 analog points to a 4700 to 4800 low in May, early June. So sort of around that late May, early June area, that's when we could probably expect a bottom here in the S&P 500, at least according to this analog right here. Now don't get me wrong, we could definitely rally to new all-time highs and keep going higher from here, but history would suggest that we probably do go to this 4700, 4800 level here, and this is an absolutely fantastic analog. Something else supporting this is actually when you look at the aggregate of all years of the S&P 500 after big start to previous election years. 2012 was an election year, so is 2024, and you can see when we've had a big start, we actually normally pull back, not quite as steep, to this May, June area where we do find a low, and we continue the rally and reach annualized returns of about 12.75%. So very interesting data right here. This does support the fact that there probably is, if not a pullback, maybe just sideways chop for the next 4 to 6 weeks here in the S&P 500 before we do continue the rally onward and upward in the S&P 500. Now guys, we're going to look at some of BOFA's charts. We look at these every single week because 78% of fund managers look at this technical analysis. They have access to BOFA's private investment research. We do too, and these are the charts they're looking at this week. This is US corporate BAA versus the US 10-year Treasury note spread. Now the BAA is not quite AAA bonds, but not quite junk debt. It's right in the middle of the two. So this is AAA bonds, this is junk debt. BAA bonds is this right here. The US corporate BAA versus the US 10-year Treasury note spread remains benign and has narrowed to its lowest level since 1985. So credit spreads continue to tighten. That means credit risk is not that high, and the market continues to believe that these corporate entities will service their debt and they're not demanding a high premium over the 10-year Treasury, and that's why these spreads are narrowing. Pretty much means there's no real issues in the market right now, and this is one of the best indicators to look at as to where we're going, because a steep rise here signaled in 2008 was a precursor to the 50% sell-off that we pretty much got from about the middle of 2008 to about the start of 2009, because these spreads are widened in a very, very quick fashion. At the same time, this is the S&P 500 and US high yield option adjusted spread. The OAS remains high with a benign trend that has supported new highs for the S&P 500 into February and March. Since then, a widening from a double bottom off the March and April lows on the high yield OAS has confirmed the tactical dip in the S&P 500. Now you can see here that the spreads on the OAS did widen ever so slightly. They are coming back down, but this was a precursor to the S&P 500 pulling back 5%. And you can see why we had a bit of a relief rally early this week, Monday, Tuesday, because the OAS actually did pull back a bit. So spreads did widen ever so slightly, but it wasn't enough to cause any concern. And you can just see how sensitive the S&P 500 is to rates right now. And that's essentially the big takeaway from this data. Now looking at the S&P 500 and the 3-month VIX relative to the VIX down below, and both are quote, the 3-month VIX relative to the VIX is nearly oversold. The tactical sentiment indicator closed at 1.0166 on the 4th to the 15th versus the oversold threshold of 1 and below. However, like the percentage of stocks above the 10-day moving average, the lack of a lower low on the VIX 3M versus the VIX could also be the start of a bullish divergence. So this chart doesn't really show it very clearly, but pretty much as the S&P 500 continued to move lower, the VIX actually moved slightly higher, or the VIX, the 3-month VIX versus the VIX moved slightly higher, and that was the bullish divergence they were looking at. They show the same thing here. A bullish divergence formed because the SPX dropped to 4953 on the 4th of the 19th as a percentage of stocks above their 10-day moving average improved from its 415th low. So pretty much, the amount of stocks above their 50-day moving average improved. The S&P 500 continued to go down thanks to some of the bigger players, like Nvidia was down 10% on the day. That actually dragged the entire index lower. Okay, today, but the average stock in the S&P 500 actually moved higher, and this is a bullish divergence. And essentially what BOFA is telling us in these two charts is that this bullish divergence can be bullish, and it does show that there is strength underneath the hood. It's just that these big players need to get in line. We've seen a lot of volatility with Nvidia. We've seen Apple come under pressure. We saw Meta drop significantly after its earnings, but the average stock is reacting really, really well. And this is the type of stuff you want to look at, because eventually these big stocks, these big boys will get the acting order. That's why they're at the top, because they're such great stocks and investments for the long term, but not without volatility. And that's what you get for investing in stocks. You have to contend with a lot of volatility. The average year normally has 7 3% dips, and we normally get about 3 5% dips. And this is very, very telling. And when we do get a peak to trough drawdown of 5%, you should really just look at this as a buying opportunity. The same is true with a 10% correction. We normally get one every year, and you normally will get a 5 to 10% correction at least 1 to 3 times every single year. And you can actually see here that a severe correction of 15% or so only happens about once every 2 years. Guys, now data tomorrow, the big one, personal consumption index. We're expecting 2.6% for the year over year, headline and core 0.3% for the month over month, headline and core, so the figures are the same. Anything above this would be considered hot, anything below would be considered cool. We also have Michigan consumer sentiment, and then the 5-year inflation expectations. And then next week we have QRA, the refunding announcement. We're just going to see what bonds Yellen's going to give to the market. The middle class continues to get screwed, but hopefully they continue to get less screwed than they were in the last quarter. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.